Good morning, I'm David Green. I've just given a talk at the Stellenbosch Business School's Leaders Angle entitled Energy, Mass and the Speed of Light, subtitled Understanding Risk in Financial Markets. Briefly, the talk is about making sure that we move from what is really old school, special case thinking about investment management and look for a general case, a broader understanding of risk and how the financial markets really work. What follows is an edited version of that talk. Let me start with the end. You know, Stephen Covey says you must begin with the end in mind. Well, the interesting thing is that the world has ended 3 times in the last 3 years. On the left is the cover from The Economist magazine in October 2008. The one on the right is July this year. The only difference I can see is that the little man has changed into a big shiny €1 coin. Here's a little picture, and it's one of the few slightly technical things we'll talk about. Let me explain what's going on here. You are working, earning, and saving and investing for your retirement, and when you get to the point of retirement, what happens? You buy something called an annuity, which means you put your money in one place, and from that moment on, you start to draw money out of that pot in order to fund your lifestyle. The good news is, you get the green line on this graph, and this graph covers a really scary period from May 2006 through the global credit crisis, the scary dip in the middle, and actually the sovereign debt crisis of May 2010 last year is that. Now, why do we call it the double whammy of living annuity drawdowns? Well, you're drawing that 5% in order to fund your lifestyle. Let's say you are drawing out of your retirement savings pot 20,000 Rand a month. All goes well until the market, the equity market starts to fall. You still need 20,000 Rand, that doesn't change. And finally, things reach rock bottom, they start to go up again, as on the right-hand side of that scary dip in the middle. And the problem you discover now is the second whammy. You have fewer units because you had to sell more, and it's more difficult to participate on the upside. In the context of this picture, a picture that will affect all of us, how our investment managers think about risk is absolutely crucial. I like this quote from Albert Einstein. The significant problems we face cannot be solved at the same level of thinking we were at when we created them. So, let's talk a little bit about Albert. These days, when you type E equals mc squared into Google, you don't get Albert Einstein. You get this young lady who looks like one of Santa's friendly elves, and there's her dog. And she's famous because she produced this album called E equals mc squared. So she gets all the credit these days for E equals mc squared. It's not really fair, but Albert is no longer around to defend himself, so she's the one who pops up. Let's talk about the original E equals mc squared though. The 2 most important bits of the theory are those 2 simple sentences over there. The laws of physics are the same in all inertial frames of reference. What does that mean? There's a whole new way of thinking. The thing of E equals mc squared, that energy is the same as, equivalent to, and exchangeable with mass at the speed of light. Man, that's huge. Within a couple of years, scientists are talking about nuclear energy. This took him a few years to figure out, and you can see involving an enormous amount of formulas and mathematics. But a few years after that, he got to the general theory of relativity. Acceleration and gravity, he said, are the same thing. A remarkable insight has suddenly got even bigger. And out of that, we start to think about things like black holes, where gravity is so intense that light itself cannot even escape. The most important one that I want to leave with you from just this example is how knowledge grows. How does this apply in the investment world? Is there a special case? Is there a general case? What does it look like? Well, it's a bit like the beginning of the Bible, which says, in the beginning the world was formless and empty. For much of history, thinking about investments was like that, kind of formless and empty. He says, you need to think about return, you need to think about risk, correlation, and you need to put that all together in a pot, stir it, and out comes something called diversification. That's the foundation of his theory, that kind of thinking, and it gives rise to all kinds of stuff. The idea that, unlike Mark Twain, who said, put all your eggs in one basket and watch that basket, he said, no. Put your eggs in different baskets. And we see we've got a couple of baskets there of different types of investments. In the top right-hand corner, we've got houses, shares, what looks like agricultural futures, gold coins. As long as you are sufficiently diversified, well, the risk ain't going to get you. So there's the special case. Suddenly the way people think about portfolios is completely different. So now we've got to diversify. You see, I'd like you to consider a bold new strategy. Stocks, bonds, cash, and for diversification purposes, a few crazy get-rich-quick schemes as well. And if you combine it all, you'll be absolutely fine. Where is the general case in investing? And what might it look like? That's really the heart of what we need to think about this morning. See, a lot of the special case is built on the thinking of the guy you see there at the top in the middle. His name is Carl Friedrich Gauss. He lives from the late 1700s to the early 1800s, and he is one of the most remarkable mathematicians of all time. To give him the credit that is his due. He gets his name and his face on the old German 10 Deutschmark note, and you can see next to him on the left-hand side there is his invention, the bell curve. A fantastic example is this man, Mr. David Vinier. He was the chief financial officer of Goldman Sachs in 2007, and when things started to go pear-shaped, he said the most remarkable thing, and it's there on the screen. This thing in the bottom right-hand corner here looks like another bell curve thing, but actually it's not. It's the longest timeline you've ever seen. From this point over here until this point over here is 13.7 billion years, the age of the universe. So there's some cracks now in the special case of investment thinking, just as this graph illustrates a bit of a crack in the special theory of relativity, and you see those scientists hovering near the black hole that's about to suck them in then. Where is the general case? I have tried to pursue this for a good couple of years now. And my research led me to this particular man here, Dr. William Shadwick, who lives sometimes in London, sometimes in Canada, and sometimes in Buenos Aires, I think in South America. And we start to talk about the things that I have spoken to you about already. We speak about science, the special case, what's called epistemology, how knowledge grows from the special to the general case. And he started to talk to me about risk. He said, investment managers know nothing about risk. Risk didn't start with investment managers, and they have an enormous amount to learn about risk. The insurance industry has been figuring out how to price risk, how much people should pay them for taking on risk, for centuries. Value at risk, nice and elegantly says, it's the most that we should lose 99 days out of 100. He said, have you ever thought about the fact that that is precisely the same number as the least you should expect to lose on the remaining 1 day out of 100? I'm going to talk only about the little graph in the bottom left-hand side there, just to explain to you how dramatic a change that sort of thinking is. You can see the dark blue bars. Those are dark blue bars representing how often negative returns on that scale from minus 1 over here to minus 7 over there occurred in early 2006. So not a particularly bad period. So that's what the world actually delivered. The nice blue curve in the background says that's what the bell curve, Gaussian mathematics, predicts. And the bell curve stops precisely here. The bell curve doesn't offer us any mathematics to help us get a handle on what might happen on the left-hand side, the really scary stuff. This is one example of how different models and different thinking can help us get a better handle on the important stuff about risk. We looked at daily information over here. This is monthly information for the fairly long period from 1925 to 2010. I say fairly long because it's nothing like the 13.7 billion years that we've already spoken about. This is how often monthly returns are either nicely positive or sadly negative, and the dark blue bars are reality, what history actually served up. The blue shape in the background is the bell curve, and you can see for yourself how well or not that bell curve actually matches the reality of what happened over that period. And the little circles I put there are events that happened month by month, which the bell curve had nothing to say about at all. But what I want to do, just to end off with, is to just apply the fairly focused set of insights to the problem I posed to you at the start. Let's say that what we want is a mathematical model, not based on the bell curve, of course, which is simply going to adjust the amount that we have in equities based on that kind of extreme value theory, fat-tailed view of risk. So it's just a different mathematical model, and it doesn't rely on human input at all. And we just said, let's see if that would make a difference. The purple lines are the consequence of doing exactly the same thing, having this annuity, starting with half of it in shares and drawing down still only 5%. But what happens is we use a new understanding of risk to adjust how much is in shares and how much is in cash from time to time. And so that 50% isn't static anymore. The thin purple line is what you get after inflation. Unfortunately, inflation still eats away at your money. But the good news, at least, is using a different model of risk, at least you're not going backwards over this particularly difficult period. So let's go back to the big thoughts that I would like to leave with you. We must apply general case thinking. That involves completely reconceptualizing what investment risk looks like and making sure that we build models that actually make a whole lot more sense than the models we've lived with for the last 60 years in the context of the real world. Let me leave you with this quote from Albert Einstein that nicely wraps it together. To raise new questions, new possibilities, to regard old problems from a new angle requires creative imagination and marks real advance in science. Thank you very much.